Ladies and gentlemen, boys and girls, children 18 plus, you are tuned into the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
Just John.
What's up, man?
How you doing, Just John?
You zooted off that Sudafed, huh? How much you take?
Oh my gosh, yeah. You would have thought that I chopped it up and snorted it. I promise you, it was one Zyrtec and one Sudafed last night after you and I got home.
Right.
We had a fun road trip yesterday.
It was great. Shout out Steve Strother.
Yeah, shout out to Steve. Steve just opened up. He's a new market manager for Waterstone Mortgage, opened up the Jacksonville market, and you and I drove up to Jacksonville to participate last night.
To celebrate.
Yeah, he had a great grand opening event.
Nice turnout. It was a great time.
Yeah, had a really good time, and it allowed you and I to get stuck in the car for 2 hours up, 2 hours back.
If you had, that's 4 hours together.
4 hours together.
Got a lot done, though.
We did.
On the laptop.
We got a lot done on the laptop. Keep on throwing it out there. T-Lop Online. Here's what's interesting. Like, so many of our episodes and so many of our shows, I think I forget and you forget that they have shelf life that lasts infinitely, right?
Correct.
Like, forever.
Right.
Like, this shit's forever.
Right.
So, like, there's someone who's going to probably find the podcast through the website.
Right.
And they're going to go back and listen to this episode. Like, wait a minute, I'm so confused.
I'm lost.
Yeah, I'm totally lost.
Yeah.
So we are in the beginning of June 2021.
Damn.
Yeah, right? And we do not have the website yet launched. But someone's going to find this episode in 4 or 5 months.
Right.
They're going to tune in.
Like,
Maybe in 2 years they're going to tune in. Right. And then just know that when this was first recorded and laid out, that we did not have T-Lop Online.
Okay.
All right. So you and I got to work on T-Lop Online last night. Yep. It was pretty fun, too.
Yeah, it was good.
Yep. We had to listen to music.
Yep.
Well, I say I listened. I think I probably, more than likely, I woke up this morning, I'm like, God, I bet John hates me today.
No, it was good.
Yeah.
No, it was good, for real.
Introducing you to, like, Cody Johnson.
You know, I have an eclectic palette when it comes to music as it is, so I'm always down to hear new music.
What we do, we went from Cody Johnson to Megan Thee Stallion to NWA, then into Calvin Harris. Yeah, we had it all going on last night.
Yes, we did.
Yeah.
You know what we have going on today, Dio?
What do we have going on today, John Coleman? Just John?
The 4 C's.
The 4 C's?
Yes.
4 Seasons? No, we're not talking about, like, Frankie Valli and that whole crew?
No.
No, the 4 C's.
Correct.
Like credit, capacity, collateral, and capital.
I think that applies to what you say, 78% of the American populace?
Well, this episode, like, think about it. If you are ever going to purchase a home and you need financing, if you're ever going to sell a home, right, like that's your profession, right? You're a home builder or you're a realtor.
Right.
Or if you're ever going to lend money to somebody who's needing that money to buy a home, I would guess at least 3/4 of the American populace, this episode is going to apply to them.
Nice.
It's the basics. It's the easiest way to wrap your head around what it takes to qualify for financing.
Okay.
Right? So back in the day, it was taught the 4 C's.
Right.
Credit, capacity, collateral, and capital. So we're going to discuss what the 4 C's mean.
Okay.
Here at Waterstone Mortgage, we teach PAIL.
PAIL.
Property, assets, income, and liabilities.
Right.
So if you have a pen and paper at home and you're playing, or if you're in your car and you want to pull over into the local Starbucks parking lot, or maybe you just want to hop in a Chick-fil-A line because we know that's going to take 3 hours as it wraps around the building 17 times. Now, what's interesting is Chick-fil-A can get through that line
very quickly
in 45 minutes. But if I go to a NCAA basketball game, I can't get out of that line to take 3 hours.
Right.
But nonetheless, if you have the time, get out a piece of paper and then write this down.
Right.
So I kind of taught and was what I learned, and then I taught PAIL. But I realized others throughout the industry coach the 4 C's.
Right.
But they really are the same exact thing. So like when you think of credit, for me, PAIL is property, assets, income, liabilities. And the 4 C's goes credit, capacity, collateral, and capital. So if you're trying to correlate the two, credit would be the L in PAIL, which is liabilities. All right. Capacity would be the I in PAIL, which stands for income.
Okay.
All right. And then you have collateral, right? So that would be the P in PAIL for property. And then capital would be the A in PAIL for assets. So we're going to teach this, the 4 C's, and we're teaching it that way because that's what was requested of us.
Right.
Like, we're kind of like Delilah back in the 1990s and early 2000s. You want to do that again? Do it again.
Delilah.
Yeah, you remember that every Sunday night you could call in and
I mean, if you ever got through.
if you ever got through. Did you ever get through,
No,
John?
I told you, I called once because I had a crush on this girl and I thought it'd be cool, but I was just dumb and naive.
Do you remember what song you were gonna ask Delilah to play for this girl?
Something stupid. I don't know. I don't know.
You don't know. Maybe Boyz II Men?
Nah. At the time, it was a banger, but I can't remember. Maybe Quad City DJs, but that wasn't really on our playlist. At night. I think, never
Oh,
mind.
yeah.
Okay.
Okay, I
You
didn't
looked
know.
at me?
Yes.
Quad City DJs. Yes, I know.
Oh, I think of Quad City DJs as something totally different than that. Yeah. Okay, cool. Yeah, you and I are still stuck on music from last night.
Yeah.
All right. No, but we're going to teach because like Delilah, we take requests.
Right.
Right? Like, look, if you're tuning in for the first time, I don't know if you're tuned in on YouTube, which if you're not, you can follow us on YouTube, which is at The Loan Officer Podcast. You may be tuning in on Spotify or on Apple Podcasts, on Google Play, or anywhere else you can find podcasts. We are at The Loan Officer Podcast. If you want to follow our social, we are on TikTok, Instagram, and Facebook.
At the Loan Officer Podcast?
At the Loan Officer Podcast. You can find me individually. I am Dustin Owen on LinkedIn. The Loan Officer Podcast is also on LinkedIn. And we're actually like just a smidge away from having 1,000 followers.
Let's go.
Just on the LinkedIn page.
Let's go.
That's pretty cool, right?
It is. You're really getting really good at like dovetailing that in, by the way.
Yeah, well, I think LinkedIn is one of the most hidden treasures
Right.
of all the social media platforms, especially for people who are in a more white-collar business type environment.
Correct.
But it's really been phenomenal for the exposure we've had for this show.
Yeah.
All right. So the 4 C's, credit, capacity, collateral, and capital, also known or taught PAIL, property, assets, income, liabilities.
Right.
We're going to teach it credit, capacity, collateral, and capital, the 4 C's. At the very end, I will maybe just flip the script and kind of run it through quickly what it would look like PAIL.
Okay.
Why I love these is that if I'm a loan originator and I am sitting at a bar drinking a Negroni or a High Life IPA, right? You like Negronis, I like High Life. If we're sitting at the bar, I could discuss with you buying a home and financing it if I could just remember what the 4 C's were, if I could just remember what PAIL was.
Okay.
If I'm a realtor, my job is to be a badass realtor. I'm great at marketing properties, negotiating contracts, figuring out the value of a home, what it should sell for, what we should offer on it, etc. But I also need to know a little bit about what it takes for someone to qualify for financing.
Yeah.
So without having to be some kind of a mortgage expert, I could, if I understood credit, capacity, collateral, and capital, the 4 C's, or if I understood PAIL, I could have an intelligently enough conversation with my potential home buyer or home seller to get them pointed in the right direction before they could go speak to an expert. Right? Now, if I'm just sitting at home, I'm playing at home, right? And maybe, what do they call it? HGTV porn or something like Zillow porn or house porn.
Okay.
Right? I'm on the house porn, right? That's HGTV. That's going on Zillow or Redfin. And I'm just like kind of playing the what if game. Like I play that game like, what if I won the lottery?
And
What if it was 3 million? What would it do to my life? What if it was 13 million? What if it was 30 million? Right? Well, people do that with buying homes and renovating homes. Well, if I'm playing that what if game at home, and I want to know what would it take for me to qualify, just understanding the 4 C's or understanding PAIL.
It's a good place to start.
It's a good place to start. And I used to teach it and still do from time to time to the consumer, like to think of the 4 C's in PAIL like there's four legs of a chair. Right? PAIL is 4 letters, so 4 legs of a chair. Typically, if you take one leg off of a 4-legged chair, you can sit on that chair.
It's not going to be comfortable, though.
Won't be comfortable. It's going to be a little bit wobbly. If you take a second leg out, you're doomed.
Yeah.
And there's no way in hell you're going to be able to stand on just one leg.
Right.
Right?
Right.
Well, keep that analogy in mind as you follow along, because this is what it's going to take for you to qualify for a home. So we're just going to run right through it.
Let's do it.
What is credit? Okay, well, what is credit to you, John Coleman?
Credit is what, the credit cards and stuff, what you're lent, what you're allowed. I don't know, man. I'm not good with this stuff. What is credit?
Yeah, like for me, I think, what's my credit score? What's my FICO? What's my beacon?
Yeah, I just think of my Best Buy credit card and how many points I have on it.
Okay.
Yeah. That's what.
So cool. So credit's very vague.
Yes.
To you, you think credit cards and Best Buy points. I think what's my FICO?
Right.
Right. Credit is, what is your credit history? How long have you had credit? How have you utilized your credit? And by the way, what's your credit score?
Oh, okay.
It's not just credit score though.
Not just credit score.
Not just credit score. right? Because you could have a 700 credit score, which is a good score, but you could have also had a short sale. That means you sold a home for less than you owed, which means you short paid back your lender, right? You owed your lender 200 grand, but you only gave him 180.
Yeah.
Well, many and most loan programs make you wait a certain time period before you're ever able to finance again.
Really?
Yeah, so like there may be a 2-year waiting period, a 3-year waiting period, a 4-year waiting period if you had a short sale. So credit score alone, if I said, you said, hey, DO, I have a 700 credit score, and credit to me only meant credit score, I'd give you false hopes that you would qualify. Because credit is more than just your score. It's more than just your best by points.
Right.
Credit is how long have you had credit for, right? Have you had credit for just 8 months, or have you ever had it for 80 months? Or have you had it for 800 months? I don't think you have 800 months,
that's a
but
long time.
yeah, it's a very long time. But you see where I'm going with this.
Right.
Like, and it's also what type of credit do you have? And how much do you owe?
When you say what type of credit, does that mean like a car loan or?
Yeah, like a car loan's an installment loan. Have you had mortgages in the past? And if you had mortgages in the past, did you have ever any late pays? Are they student loans? So if they're student loans, but all of those student loans are, all those student loans are deferred, then do you really have a payment history?
Not really.
Like, I know you don't have any late pays, but
Right.
you've never made a payment.
Right.
So is that trade line really as valuable as a car loan that maybe you've had for 36 months and never missed a payment on?
Do you have a lot of? Do you see like a lot of people, individuals in that industry, when they talk about credit, do they just go to credit score and that's kind of all they talk about? They hold it high and mighty. That's it.
Well, so like a very common statement, proclamation by a consumer. I have great credit.
Yeah.
I'm like, oh, cool story, man. Like, high five.
Yeah.
That's awesome. But we still need to look at your body of credit. Like I think of someone who abuses performance-enhancing drugs. They have a great-looking body. Well, if you're into that.
Right.
Like, I'm into jacked-up dudes and
Right.
girls. Like, I think that's, like, looks good.
Yeah.
Right? Oh, my gosh, look at you. But what we don't know, right, is their heart is 30% larger than it should be, and the kidneys have swollen, and the liver is damaged.
Yeah.
So just because that's always the analogy I
Yeah.
give. Like, you could have a great credit score, but if your body of credit is diseased, that needs to show as well.
Yeah.
So I can't just look at you and say, "Oh, John, you're healthy. Yeah, you look."
Yeah, you got great.
Yeah, no.
Okay.
We need to draw some blood. We need to weigh you, measure you.
That's great. Yeah, that makes a lot of sense.
So like when we talk about credit, that's what we're talking about. When we're talking about liabilities on PAIL, it's very similar. Like, hey, what are your liabilities? Not just your credit score, but who do you owe money to? How long have you owed it for? What's the likelihood of you continuing making those payments on time? Can you afford for me to add more debt to your debt load? Now, that'll get a little bit into capacities. That's the next C, and we'll slide right into that right now. But that's, in a nutshell, what credit is. It's not just your score. That's the big takeaway.
Yeah.
It's not just your score. You could have a 660 score, which is average to below average, but your body of credit could be just solid.
Really?
Maybe you have a 660 because there's a $79 medical collection that you knew nothing about.
Right?
And it's like, well,
Yeah.
wait a minute. Or maybe you have a 660 and it's only because your credit card company recently cut your limit from $10,000 down to $4,000. You owed $3,900 on that credit card because you just
maxed out,
paid for
yeah.
the family vacation on your credit card to get the points.
Right.
And all of a sudden, your credit card showing is maxed out, and a maxed out credit card will drop someone's credit rating. So what matters to that person is what is your body of credit, not necessarily your score.
great.
So just know that the credit aspect is more than that. So capacity. So in PAIL, P-A-I-L, PAIL, we talk about the income. And the 4 C's, we talk about capacity. And capacity really dives into your DTI. Debt to income
Ratio.
Yeah, debt to income. Like, what's your debt to income ratio? I would say, in my experience, the number one factor on whether or not someone qualifies is based off of their debt to income ratio, which is their capacity. What is your capacity to make sure you make this mortgage payment on time every time without fail? Because think about it. You could make $1 million a year. You could have $1 million in the bank. But if you went out and bought a $2.5 million house and you put all your $1 million as a down payment, and your payment on that $1.5 million loan was going to run you somewhere around $10,000 a month, But then when I looked at your $10,000 a month housing payment, plus your condo at the beach payment, plus your boat payment, your motorcycle payment, you, your wife, and all 3 of your kids have fancy car leases at $800 a pop. And all of a sudden, and oh, by the way, you may very well make $500,000 a year.
Yeah.
But all of a sudden, your capacity ain't shit.
Damn.
Right? You're maxed out capacity-wise. Your debt-to-income ratio is too high. Ma'am or sir, I think it's great that you make $500,000 a year. I think it's awesome you have $1 million saved. I think it's fantastic you have an 800 credit score.
Right.
But you're over-leveraged.
Rhetorical question. Have you ever seen this in your real-life experiences where a person has like, yo, I got all this money. I got all this money saved up. I got a great credit score. And it's like, sir, you don't qualify.
Close. Not all of that.
Okay.
I probably embellished.
Right.
I have looked at someone who made $700,000 a year as a surgeon who could not, quote unquote, afford the $1.2 million home that they were trying to buy.
Right.
Because, and it was 5 children, by the way. Damn. All 5 kids, adult kids, had Rovers, Lexuses, Beamers, leased out.
Yeah.
Boats, jet ski, camper, Harley, beach condo.
What?
Oh, yeah. Oh, yeah. And now that person also didn't have the down payment. Right? So like it was close. The income was there and the credit was there.
Yeah.
But they didn't have the down payment to qualify for that high of a purchase price.
Yeah, I mean, it's still good to know if people, just because you have a boatload of money doesn't mean you can just go out and just buy anything.
Yeah, well, just because you make a lot of money.
Right.
Right? Just because you make a lot of money. Like when we're talking about your capacity, it's not just like how much money do you make, but how long have you been making it? How are you paid?
Ah, okay, right.
Like, and on PAIL, when we're running that acronym, we're talking about your income. Right here, we're talking about your capacity. But in order for me to figure out your capacity, I have to figure out from your credit, what are your monthly debts? From your capacity, I have to take those monthly debts and I have to divide them into your monthly income. Well, I have to figure out your monthly income. Well, what is your monthly income? Do you know most people don't know?
I recently, after going through, I realized that now. Most people don't know how much they make.
I would guess you probably know how much hits your bank account every 2 weeks.
Correct.
You might not know how much money you made last year.
Not off the top of my head, no.
Yeah, you're normal, John.
Yeah.
First time you heard that in your life, isn't it? You are normal.
Yeah.
But yeah, most people don't. And then for half of us, we're not paid traditionally. Like a teacher, that's traditional pay. They make their $48,000 or their $62,000 a year salary. Certain engineers, hey, I'm an engineer at Lockheed Martin, at Siemens, at Northrop Grumman. I make my $84,000, I make my $115,000 a year. But everyone else, hourly, shift differential, bonus, incentive bonus, commission, self-employed.
You got to factor all that in, huh?
All of that gets factored into someone's capacity. I have to figure out how much money do you make. And sometimes if it's 100% commission job, right, you sell life insurance, right? You're a loan officer.
Right.
Right? Well, we're going to have to look at, what were your commissions over the past 2 years? Let's divide that by 24 and let's get an average. Oh, John, you own your own business? High five, man. What's it like being an entrepreneur? Pretty cool?
Yeah, solid.
Yeah, you're your own boss?
Yeah.
Cool. Yeah, you can try and get a loan?
Yep.
Yeah, I need 2 years tax return, told me.
Whoa.
Yeah, like I need to see how much money you claim to the IRS as taxable income. Right, so that's going into the capacity aspect. Again, if we're looking at PAIL, that's going into the I.
Yeah.
So if I am a consumer, I need to understand, okay, cool, when I go to get a loan, it's not just about what my credit score is, what's my body of credit? All right, and by the way, it is what it is. Any advice I have to the consumer, have your credit pulled, have it looked at, examined by a professional, by a true blue mortgage advisor, right, an MLO. And if you don't know one, John Coleman does reach out to him. He'll hook you up.
Right.
But understand, it's not just your credit score that they're looking at. They're also looking at what's your track record, what's your history. Do you have any bankruptcies, foreclosures, short sales? If you do, that's okay. Okay, it's not going to be like a definite hard stop no. We just have to see how much time has passed since your Chapter 13 to Chapter 7,
Right,
whatever
that
the
makes
case
sense.
may be, right?
Right.
Don't worry about, oh my God, I need to go pay off that credit card. You probably don't. You probably don't. Like when we start getting into capital, it may make more sense to you for you to have more capital at your disposal than it does for you to do anything with lowering your credit, increasing your capacity.
Yeah.
That's where loan officers make their money. That's where they earn their money. It's by giving that advice up front to the consumer. Okay? So when you're a consumer, we've covered credit and capacity. You need to understand about credit score, body of credit, and also on capacity, it's not how much money you're making today. It's how much money have you been making over the past 2 years? How much money do we think are you gonna make going forward? I mean, you might have had a banner year last year because you got this big fat bonus. But I can only use that bonus to help you qualify if your employer states that the likelihood of that bonus to continue is good.
Yeah.
But if it was a one-time bonus...
So do people I could see people in a situation where they had a great year, company did great, they got a $50K bonus, like, oh, look, I made 150, I'm gonna go buy this house that I was wanted. And it's like, sir, I can't really use that.
Yeah, that's a great example, right? I typically make $65,000 a year, but last year my company gave me a $25,000 retention bonus.
Right.
Right, because think about it. For some people, last year it might have been actually not like. Please don't hang me for saying this, okay? I'm throwing an example out, but some people made more money not working than they would have working.
Yeah, for sure.
So some companies were like, "Yo, I need you to come into the office. I'll pay you a retention bonus."
Yeah.
Okay. Well, are you going to get that retention bonus in 2021, in 2022, and 2023?
Right.
So like when we're talking about capacity and we're getting into your income, or we're looking at the PAIL and we're talking about the I. As a loan officer, you have to ask those detailed questions. As a consumer, you have to be ready to answer those detailed questions. As a real estate agent, you have to understand that it's more than just, oh, well, my client has this credit score and my client makes this much money.
Sign them up.
Yeah, what's the consistency? Especially like if you're a realtor, it's great you made 20 grand last month because you had 3 listings sell. But in today's market, we know, and everyone knows, it could take you 9 months to go find another listing.
Right, correct.
Right, so that may mean you only have a couple transactions that close between now and 9 months from now. Well, if that's the case, I can't just be like, well, you made 20 grand last month. I guess you're going to make 240 grand this year.
Right.
It doesn't work that way.
Right.
All right, so staying on the 4 C's, we covered credit, we covered capacity, right? Capacity to me is the number one. I'm just going to keep on reiterating, if you're going to qualify, whether you do or whether you don't, it's based on your debt to income ratio.
DTI.
That's the killer. DTI is the major killer. Like, we have loan programs that go down to 585 credit scores. So a low credit score, you can technically overcome.
Right.
We have loan programs afforded to us if you have a boatload of money in the bank, like millions of dollars, but you don't show any income. There are such things called asset depletion loans where we can formulate income based off of your assets to get you to qualify.
Okay.
But all of those, I don't have any loan program to overcome you having a shitty DTI. Like, just don't. I just don't.
Right.
You know, there's even certain loan programs where if I run you through an automated underwriting system, it says I don't need an appraisal.
What?
So in certain cases, you can even overcome the need for an appraisal. But I haven't figured out yet a way to overcome the need for you having a extremely high debt income ratio. So to me, capacity, that is the most important.
Question for you on that DTI. What's the cutoff number? Curious. Like,
it all depends.
Like, is there like a 58? Like, what's the, you want to be like, hey, you want to have
Well,
a
so there's the book answer and there's a real world answer.
Can I have both?
I'll give you a real world answer.
Okay.
Okay. Real world answer is that if you're well qualified, you could potentially qualify for a conventional loan up to a 50% debt to income ratio. That is, take all of your current debts. By the way, cell phones are excluded and utilities are excluded. Debts to us are things that show up in your credit report. Things like student loans, auto loans, boat loans, recreational vehicle loans, other mortgages you may have, credit cards.
Right.
Take that number, add in your new proposed housing payment, divide it by your gross monthly income. And John, is gross the big number or the small number?
The big number.
The big number. Yep. So not the number you see deposited into your Wells Fargo account every other Friday. Actually, the number that shows up in your W-2, divide that by 12. Okay. So that's an easy way to calculate your debt to income ratio.
Okay.
So on a conventional loan, all things said and done, you can go as high as 50. But that's assuming you do have a good body of credit. You do have a high credit score. You do have, I mean, there's certain, you know, you're not going to roll in a 50 DTI if you have a 620 credit score.
Right.
Right, if you have a 620 credit score, that's the bare minimum needed for conventional financing. You may only qualify at a 36 DTI, but we can go to we can go to 50.
Okay, that's good.
Right, on certain government loans like FHA, we can go as high as like a 55.99.
Okay.
Yep, that's with what we call AUS approval, automated underwriting systems. Right, we're utilizing technology that has algorithms
That figures it out.
Excuse me. This damn sinus infection is kicking my rear end.
It's all good.
I am vaxxed, though. Fully vaxxed. I know
fine,
it's
man.
not the Rona, I promise you.
It's fine. It's good, man. What's next?
What's next? All right. Collateral.
Okay.
Okay. In the PAIL analogy or the PAIL acronym, it's property,
Okay.
but it's collateral. When you are obtaining a home loan, it's not just you we are underwriting, it's also the property, right? Like, hey, John, you're buying a mobile home. Ooh, okay, cool. Like, my favorite home growing up was my grandparents' double wide in Pine Hills, Florida.
Right.
Right? So, like, great economic housing. But it's a type of house that is a riskier piece of collateral, so there's going to be different underwriting criteria that go into it. Oh, it's a condo. Ooh, wait a minute. Condo, they have condominium associations. When you own a condo, you don't own anything besides the air inside of the walls. The association has lots of power, and they have control over the exterior of the building, keeping the building insured, et cetera, et cetera. So a condominium is a different, and it's a more risky piece of collateral.
Okay.
Hey, John, are you buying this home as a primary home or as an investment property? Primary home is less risky. An investment property is more risky. So that collateral, that property address, the age of the home, the type of home, how you plan to occupy it, all of that matters. That's part of this equation that we're trying to put together. So in the PAIL acronym, that's the P part, and the 4 C's is the collateral aspect of it.
All right.
And we need to make sure that we are only lending to a certain percentage of what the home is worth. So we as lenders are always going to go off of one of two things. It's always the lower of the two. We're going to go off of either the lower of the purchase price or the lower of the appraised value. Okay? In a market like we're seeing in 2021, do you think it's more likely for the home to be priced high and have the appraisal come in lower than the sales price? Or do you think the sales price is going to be one thing and the appraised value is going to come in higher?
I think the appraised value is going to be way higher.
The appraised value
Yeah.
way higher?
Yeah.
You want to rethink that, John?
Okay, no, I put confidence in it. I said it with confidence. I thought.
Did you really?
I thought, yeah.
In today's market.
I thought they're overappraising. Houses aren't overappraising right now.
Underappraising.
They're
So overappraising would be you're buying the home for $300
Right.
and appraised for $270.
Yeah, that's not what's going on.
That's an underappraisal.
Oh.
You're buying it for $300,
Uh-huh.
but it only appraised for $270.
That's an underappraisal.
That's an underappraisal.
Right.
Overappraisal will be you're buying it for $300 and appraised for $330.
That's not what's going on right now. I thought it was.
That would be amazing. Think about that. Let's think about that. If it was overappraising,
Because I thought since there's a shortage, right? There's a shortage. So I've heard recently. Maybe I'm not.
there's a massive housing shortage.
So in the end, some houses are coming in way like overappraised value. So that's where I got
No,
my answer.
people are paying overappraised value.
Oh, okay, right,
Supply and demand.
right.
Ready? This mug that I'm holding up, if you guys are listening on Spotify or Apple, I apologize. I'm holding up my ceramic coffee mug that's full of Robitussin. Okay, so this mug that I'm holding up, you and I would agree it's somewhere worth around $5.
Right.
All right, you're really thirsty though, John. You haven't had water in 3 days. For whatever reason, you can't figure out how to use your hands as cups.
Dog, I'll pay you $10 for that.
Oh, you will?
Yeah.
Okay, cool. But hey, first let's get it appraised. So we go and call our 3 friends in. And we say to our 3 friends, hey, what would you pay for this mug? Someone's going to be like, Dio's lips touched it? Nothing.
Right,
All right,
right.
we throw that one out. All right,
Yeah.
that guy's a jackass. Then we're left with 2 other people. One person says $4, one person says $6. All right, this mug's worth around 4 to 6. You and I agreed that it was only worth 5, but you're willing to pay 10. Supply and demand.
Right.
So it only appraised for 5, but you're willing to pay overappraised
Paying
value.
overappraised. That's what
You're
right.
paying overappraised value because you really want this mug because
Gotcha.
you haven't had water in 3 days.
Gotcha. You're okay.
So today, when we're looking at our collateral, in today's market, people are overpaying for what a home is worth. Okay, the home, we all know, like, this thing's worth $300,000, and people are paying like $310,000, $315,000. Which, by the way, as an advisor, in many instances, and I know this isn't for this particular episode, it's worth doing.
Yeah.
If you start figuring out, well, what's this home going to be worth in 2 years, based on the home values appreciating by 3, 4, or 5% over the next 2 years each year,
Right.
like if you want to get into a house, because this inventory shortage is not going to just like go away,
Right.
It's going to happen over time, and that's a long period of time. So that's a whole different topic, a whole different show
Right.
that we can do. But in this case, when we're looking at collateral, we're looking at your loan to value. So we have to figure out, in order to figure out the loan to value, we have to get a valuation of the home. So we're going to use the lower of the two, either appraised value or sales price.
Gotcha.
So if you're willing to pay $300, but the home only appraises at $270, we're going to run your loan based on a $270 value.
Okay.
If you're willing to pay $300 and the home appraises at $315, we're still only we're gonna use $300.
Gotcha.
It's the lower of the two.
Okay.
As a lender, you're gonna mitigate your risk.
Understood.
All right. So that when we're looking at collateral, it's not just you that we're worried about, right? It's also the property, because if something happens to you, we get to take that property back. That's our collateral. The property, the P in PAIL, is also the third C and the four C's, which is collateral. That collateral is what we now own because something catastrophic happened to you.
Right. Okay.
All right?
Right.
The last part is capital.
Okay.
If we're using PAIL, this would be assets.
Okay.
Right? And we taught a class when we had one of our younger mortgage professionals, and I don't think she understood fully the word capital. You're like, hey, I need a capital contribution. And she's like, yeah, I've never been taught that word.
Right.
I'm like, okay. I'm like, well, do you know what the capital of Florida is? And she's like, it's Tallahassee. I'm like, perfect. So you know that meaning of capital, but capital is also cash money.
Right.
Like it's how much do you have to put into the transaction? How much skin in the game do you have as a consumer? Or if you're a loan officer, how much skin in the game does your client have? If you're a realtor, how much skin in the game is your home buyer willing to put in? What's your capital? But we don't just need to know how much money you're putting down. We also need to see, do you have enough money to cover closing costs? Right? Closing costs are things like lender fees, title fees, government fees, a survey on the property, maybe a home inspection, definitely an appraisal. You're going to have the home insured. You're going to have to pay some property taxes. Like you have closing costs. And then we also have what are called reserve assets. Right? So like, how much money do you have left over? Oh shit, money. Life throws you a curveball. It's not a matter of if, it's a matter of when. What type of money do you have sitting on the sidelines to help you make your payments, live your lifestyle, if and when? Like it could be something as minor as your AC goes out, your roof leaks, the transmission in your car goes, or COVID-19 happens and you get furloughed. And it's an unpaid furlough. Do you have a contingency plan? Do you have a backup plan? Like you and I did a episode on house hacking.
Yeah.
One of my like most fun episodes to do. We just recently posted it. You did a little clip. I posted it on LinkedIn. And it's interesting because, yes, you and I taught people how they could, over a 10-year period of time, have a primary home plus 5 or 6 rental properties. But something they have to understand is they have to have enough capital to do that. Like we brag and we promote, hey, you can buy all these properties with as little as 5% down per property. But it's not just 5% down. It's 5% down plus closing costs. Plus, the more properties you own, the more capital your lender is going to want to see.
Really?
Yeah. Are you holding 2, 3, 4, or 6 months reserve payments per property? Certain loan programs, depending on how many properties you own, what if they wanted you to have 4 months of reserve payments per property? Well, if you own 6 homes and each home has roughly $1,000 a month mortgage on it, just to use a whole easy number, then that's $6,000 a month in mortgage payments. And if they wanted you to have 4 months per rental property, not only do you need to have your down payment, your closing costs, but now you have to have $24,000 left over after closing to show your lender. Now, sometimes that can be in your 401k or your IRA, right? Because most of us, we can access the funds in our 401k if we needed to, usually with penalties, so it's not advisable, right? We've had Rob Farragher on this show before. Probably now a year ago Rob was on, but he's a financial advisor who specializes in 401ks. And he taught us that, in many cases you can access it, especially in an emergency.
Okay.
But you do so a lot of times with a penalty.
Right.
So sometimes when we're talking about capital, you can use things like your 401k for that capital.
I was gonna say.
Now you can't use your dog or your little sister. There's certain things you can't use. But like if you had a life insurance policy that had cash value, then yeah, you could use that cash value.
What if I had a really dope car? Could I use that?
No. Interesting enough, you would think common sense would say so. Buddy of mine, shout out to Drew Abear. He works for Center State Bank, who actually just got bought out, so I don't know his new bank's name, but let's just say Drew Abear at Center State Bank. He works in commercial lending, and I always love having lunch with Drew, and I had lunch with him like 2 weeks ago, because the commercial side of lending is still pretty much like whatever makes sense we'll do.
Okay.
Like the mortgage lending world, ever since 2007, 2008, very black and white. It's like, hey, square peg, round hole, they don't go. Round peg, round hole all day long. And sometimes in the residential world that we live in, that we're talking about, we don't give loans to people that deserve loans because they need common sense. Commercial banking, man, they'll do that. They'll be like, oh, John, you're opening up a business? Okay, let's talk about that business. And you like lay out your business plan and you talk about projected revenue and how much money do you need? And then they look at your dope ass ride.
Right.
And like, hey, you know what? I'll give you a business loan as long as you collateralize that dope ass ride to this business loan.
No way.
Oh yeah. Oh yeah. Like Drew was telling me, he's like, hey Dio, if you had multiple rental properties, I could maybe like lump them all together and then I can give you one loan for all three of them. We can pull some cash out and you can then use that cash to go buy a couple other investment properties.
What?
Yeah, but that's all on the commercial side.
Interesting.
We don't do that on residential. So yeah, that's a little bit of a sidebar rabbit hole, but you know, don't get it twisted. That's not how it works in our world.
Okay.
But when we're looking at capital, we're looking at your checking account, your savings account, what do you have in stock, 401k. But we also have to look at where'd you get the money from, right? Like if you got a cash advance off your Amex, can't use it, right? If you went and borrowed funds from your best friend's uncle's aunt who works at Cash Advance America, can't use that either. Like if you borrowed money, we can't use that borrowed money. Now you can borrow money against your 401k because you're borrowing money against yourself.
Right.
But no, you can't. If you ever got money from family, it's a gift.
Right. Yeah. So parents gave you like $30K to help you with money.
Yeah, that's a gift. That's not borrowed funds.
Gotcha.
Yeah. Now, if you want to re-gift your parents, like for Arbor Day and Flag Day and Memorial Day and Labor Day and birthdays, then sure.
Right.
Go ahead and re-gift all you want after the fact on whatever schedule you want to re-gift on.
Right.
Happy end of the month day.
Sure.
All right.
Let's go,
yeah, you're following me on that one, aren't you, John?
Yeah.
But that's it, man. That's the 4 C's. If you can understand the 4 C's, credit, capacity, collateral, and capital, as they pertain to underwriting, risk assessing someone's ability to qualify, to repay. One of the questions that was always brought up to me early on in my career, it would be like, hey, JC, would you lend them your own money? Like, look at their credit profile. Look at their capacity to repay. Look at the collateral we're lending on. Look at how much capital they're bringing, how much capital they have left over.
Yeah.
Right? Like, if I have a low FICO score with bruised credit, someone who changes their jobs frequently, and their DTI is on the high side of what's acceptable, their collateral that they're trying to buy is an investment property condo, and the capital that they have to bring to the table is the minimum down payment required, and it's a gift from mom and dad, which, by the way, you couldn't do because you couldn't use gift funds to buy an investment property. So let's just say it was another source of funds that once they gave it, they had no money left over, they had no reserve assets. That might not be a loan that goes through, right? Because all 4 of those buckets were bare minimum. Right? You want to almost think about like if you're writing a high school paper or a college paper and your teacher gave you a rubric, right? Like when you're scoring out the rubric, it's okay to maybe have bad grammar if your structure and your research was spot on, right? You may get a 5 out of 10 on grammar, but you may get a 9 out of 10 on structure, a 10 out of 10 on content. And when you add that up, you still got to be in the class or a B on the exam.
Right.
Same thing applies to this. Like think of this 4 C's as a rubric. Right? It's okay to have one of those not be a 10 out of 10.
Right.
But when it's all said and done, are you a C plus or better? Are you a 78 or better?
Yeah.
If you're to create a rubric.
Yeah.
And if you can't remember the 4 C's because they're big words like credit, capacity, collateral, and capital, then run it PAIL. Property, assets, income, liabilities. The same exact principles apply.
Yeah.
The same questions behind the questions apply. Whether you're the consumer, you should expect those questions to be asked of you. Whether you're the loan officer, you better be asking those questions. And if you're a real estate agent or a home builder, please know that's what's going to be asked of your consumer before they're eligible to obtain financing to buy a house through you.
That was great.
Make sense to you, John?
It does now.
Do you have any questions?
I don't.
You don't? Let's do this.
Okay.
We have always dreamt of keeping our episodes under half an hour. Many times we can't do it.
Never.
Like, look, when I had the opportunity to bring in David Holbrook and Mike Smalley onto T-Lop, if it's going to take 55 minutes, it's going to take 55 minutes.
Yeah.
Right? Those guys are the top of their game and really good at what they're doing.
Absolutely.
Grateful that they came on and did an episode with us the other day.
Right.
But for today, let's make this consumable, digestible. The drive into the office is all you needed this one for.
There you go.
He's John Coleman. I'm Dustin Owen. You have just tuned in to the Loan Officer Podcast. Again, if you've tuned in for the first time, please share, like, comment. We love your feedback. We love to hear from you. If you have show suggestions, this show was done because a listener had requested it. All right?
Shout out to listener.
Shout out to listeners.
Remember the guy from Nashville? Did we shout him out?
No, we'll do it next episode.
Oh, there we go.
Next episode.
Okay.
Tune in. Tune in. It's Nashville.
Essex Mortgage.
We're going to shout out Essex Mortgage. We're going to do it twice.
Right
now at the end of this episode. Shout out to Essex Mortgage out of Nashville.
Yeah.
Look them up online, actually.
Yeah.
I wish I knew who the listener was, but he said he used like a screen name or a handle.
Screen name on it. Yeah, it was a YouTube comment. He just he got hired Essex Mortgage. He was a listener, Dr. Zapados, I believe, something to that effect. But yeah, shout out Dr. Zapados. I probably butchered that name anyway.
Well, maybe he works for Parker because I looked up Essex Mortgage in Nashville, and this really sharp-looking dude that looks like he knows his stuff named Parker showed up as a branch manager. So shout out to that whole entire crew up there in Nashville.
Let's go.
I'm going to be up there in October and in January. So if you want to meet me at the stage and have a beer with me,
let's go.
First one's on me, the next three are on you. He's John Coleman. I'm Dustin Owen. You've tuned in the Loan Officer Podcast. Like us, share us, comment. Check us out on Instagram, TikTok, LinkedIn, Facebook, YouTube, Apple Podcasts, and Spotify.
There you go.
Thanks for tuning in. That's all we have for you today. Deuces.
Peace.